Hey guys, what's happening? It's good to be back for another week of a live stream. So glad you're here tonight. We got a lot to go over, man. We've got so much stuff. I'm not sure we'll get through it all, but we're going to try. So if you're looking for a action-packed live stream, this is it. I think there's going to be some good stuff in here, especially for you dividend investors. So looking forward to kind of walking through all of that. And as always, what I try to share is what I'm doing. And if you like that, you can certainly use it. If you don't like it, just throw it away. And, all it costs you was a little bit of time. So, hey, and plus, we do talk a little bit about bees here. So one of the things I thought I'd share with you guys is that I don't know how much you guys know about bees, but one of the biggest enemies or biggest pests that bees face is this little thing called a varroa mite. It's called, its Latin name is Varroa destructor. And it's almost like a tick for bees, but it is, and it's pretty tiny. You can see it with the naked eye, but it's like, it's very, very small. But on a bee, it would be like me having a tick like this big, because bees are pretty small, and then you got this thing. So, but it's about like that big on a bee. So, one of the things we do as beekeepers is we test our bees and we treat our bees for these stinking things called varroa mites. And I've been treating my bees ever since I pulled the honey supers off. I've been treating them for the last 6 weeks. I pulled the strips out this past week and tested for mites, and the mites came back actually with a very, very good rating. So I am really pleased with the way we're managing mites this year, and I think the bees are pleased too. So they even told me that. They buzzed by. They said, "Hey, thanks, dude. Appreciate it. Come back and see us again sometime." No. Anyway, I think they're going to do well this year, and obviously what we're trying to do now is getting them to have enough stores and to be healthy nutritionally, as well as just virus and all that kind of stuff, to get them to be well enough so that they will overwinter, that they will come through the winter good, and that we don't lose any hives, because that can happen in the wintertime. They either freeze out or get sick, and so we just try to protect them from this pest. So that's one of the biggest things about a beekeeper. I don't make honey and I don't make bees. I just try to help them manage their risks, and one of the risks is their varroa mites. So thought I'd share that with you. I'm excited about that. That's been a big deal for me this week. So, but the big deal right now is dividend growth investing, and that's what we're going to talk about. We're going to probably get into some stuff that's going to be you may go, your eyes may glaze over, but you can always come back. You can always pause it. You can always think about what we're talking about here, because I'm going to share with you not only my portfolio, but the rationale, the theory behind what I do. And we're going to look at the performance of the portfolio and all of that good stuff. So hope you're in for a fun ride. So buckle your seatbelts. Let's get started. First of all, let's see who all's here. As we like to do, we see Steve. Steve, last night someone mentioned CTO, but Russ had no time. Can we look at this one tonight? Yeah, absolutely. I'll put that on my little sheet of paper here, and we will circle back, because it actually, I think that's a REIT. It actually fits in nicely with one of the topics that I wanted to talk about tonight. So hopefully we'll get to that, Steve. Thanks for mentioning it. And hello. All right, we got Rust Moments here. Happy Monday to you. Billy's back at school. I'll tell you, Billy, this is going to be like advanced level class here, buddy. This is like Algebra 2. I remember having the toughest time with Algebra 2. And I'm not sure if it was because Algebra 2 was that tough or if I was just not motivated. Maybe that was probably more of what it was. But, I went on to college and I took calculus and stuff like that. So it's not like it hampered me forever, but it was not my favorite class. Good evening, Pat. The weather's probably really nice up there for you right now. BUI. I'll put that on the list. Buoy. Is that like a gull? Gull and a buoy? That was awful. Sorry about that. You can edit that out. That'll be fine. Gendry's from the Dominican Republic. Dude, where were you? You say now from the Dominican Republic. Does that mean you're on vacation, or does that mean you moved to the Dominican Republic? I'm interested to hear more about that. That sounds awesome. Get the bees restaurant heaters. Yeah, that's that's actually a good idea. I'm thinking of doing that actually for the deck out back, because here in Alabama, the summers are really hot and it's really difficult to air condition an open air deck. But having one of those restaurant heaters that you wheel around, it's a big tall thing. I think that'd be kind of cool to have out there. Maybe a couple of those, and then it expands the season that we can use that covered deck back there. So that's actually a great idea. I don't know that the bees would appreciate it too much. I won't go through all the genetics and stuff. Genetics is not the right word, but the entomology of why that would cause them problems. But it would certainly work on my deck. So that's a great thought, great idea. Rent for the bees is honey. Absolutely, Billy. That's right. They produce the honey. As a matter of fact, I've got one hive out there that. Okay, I'll digress for a moment. You guys hang with me for a second. But bees are housed in something we call supers. That's basically a box with frames in it, and you can get different size boxes, different number of frames, different size frames even. So we'll just kind of leave it at that. So you have, some people have like one box as the brood chamber, and that is where the queen lays her eggs and they raise their young and stuff like that. So I'm trying to create where I've got two brood chambers so that when they go into the winter, they got plenty of food in there, and trying to get that going. So I've got one hive out there that right now has three brood chambers. There are so many bees in there. It is crazy. So they're going to have to start scaling back a little bit. And I've thought about even putting another box on there and seeing if they won't put some honey in that box. Maybe I get a little bit more honey before the winter sets in, because their hive is so heavy. It is just basically full of honey. So they need some more room. Or they may try to swarm. And anyway, that's not you guys' problem, but it is certainly a good problem to have for a beekeeper. Some people can't keep their bees alive, and I'm saying, hey, I've got to get this hive to scale down. So that's good. You got stung by a yellow jacket as a kid, so I don't like bees near me. Hey, I don't blame you, Rust. There's a couple of these little pesky things that I really don't like. A yellow jacket is one, and a wasp is the other. So, I just don't like them. They really don't. I mean, they're good pollinators, don't get me wrong, but I just don't like them. I don't like them at all. The yellow jackets will actually set up a nest in the ground, and you normally will find them when you're mowing the yard, and they come out and try to light you up. So I do not like them at all. So I'm with you, man. And it does take a little bit of time to when you're working with bees. I remember when I first started working with bees, just that buzz, even though you have your suit on, your gloves on, you know that you're behind the veil, it's still it's unnerving when you get all that buzzing going on and you're going, and you realize that you're standing in the middle of probably, 30,000 bees. So it takes a little bit of getting used to. What's up, Fast Eddie? Yeah, the bees are doing great. I am very pleased. All 6 hives, I think, are doing fantastic. So I am very pleased with the bees at this moment. Now it's just a race to get them enough food to last the winter. And I think most of them are pretty much there. So we're in good shape. I've got no qualms at this point. Gendry is vacation time. Money is working hard for me in America. That's great, man. I'm glad. I hope you're having a great vacation. And I'm really stoked that you decided to join us when you're in the middle of the Dominican Republic on vacation. So that is fantastic. Glad to have you guys here. So, hey, let's get started. We've got a lot to cover. So let me do this. Ooh, look at that, man! That's a good-looking hat, isn't it? Once I started wearing this hat, I was like, "That is the hat." I really like this hat. I got it up in where did I get it? Jackson Hole, Wyoming is where I got it from. So, all right. So we're going to do a portfolio review, but before we get there, I just wanted to remind everybody. Last week, 2 weeks ago, we created this AI portfolio using Gemini and an AI portfolio using ChatGPT. So we decided that every week on a cumulative basis, so this is not week by week, this is cumulative, starting on August the 11th, which is when we actually did the creation of those AI portfolios, that we're going to measure the AI portfolios against the 3 major indexes, as well as the Wealth Circuit Investing portfolio. This is just to remind you where we were at last week. The Dow Jones was up 2.13. We were in second place at 1.73, and then the 2 AI portfolios were dragging in last place. So I thought I'd update again for this week, which again is now, instead of 1 week like it was last week, it's now 2 weeks. So it's cumulative. So here we go. Are you ready? Last place is Nasdaq. Believe it or not, the last 2 weeks, Nasdaq has returned 0.3%. So it's not like they're losing, not like, if you're heavy in Nasdaq, that you're losing money, but they came in last place. So we got that going for us. Then 5th place is ChatGPT's portfolio. They were up 0.7% over the last 2 weeks. Then we have the S&P 500 index, which is up 1% over the last 2 weeks. Now, if you kind of extrapolate that out, 1.03% over a year's time, which would be 1% over a 2-week period. There's 52 weeks in the year, so there would be 26 2-week periods. So 26 times 1% is 26%. I think we'd all love to have a 26% year. So S&P 500 did very well, but it's only in 4th place. So let's see who's next. Oh, the Gemini portfolio is 1.43%. So that's fantastic. And I also put in here what the gain or loss would be in the portfolio for each of these gains and losses. So second place, again, is the Wealth Circuit Investing portfolio. We were up 2.2% over the last 2 weeks. And then obviously first place then is the Dow Jones. And I think somebody pointed out last week that UNH is in Dow Jones. And so anyway, it's probably driving a lot of that. But so yeah, we're 2.2% over the last 2 weeks. Very happy about that. So anyway, so that I thought we'd just kind of kick off with that. I thought I would also tell you that our Wealth Circuit Investing year to date, this is not the last 2 weeks, this is year to date, compared to the major indices of S&P 500, Nasdaq, Dow Jones, and Russell 2000. All of those, we are now back on top. You see the green line. I don't know if you can see that, but it's the green line. We are now back on top. Here are the numbers for you nerds who like numbers. So the portfolio is up for the year 12.3%. The S&P is up 10.9. Nasdaq's up 11.8. So we passed the Nasdaq this week, and Dow Jones 8.4, Russell 2000 is up 6.8. So not only are we ahead in the raw numbers, but we are also ahead in the risk-adjusted returns. So portfolio is doing really well this year. I'm very pleased with that. Then when I step back and I look at it from a long-term perspective, if I go back to 2021, and I start the portfolio there and then take the returns that I got each year for the Wealth Circuit investing portfolio as well as the S&P 500, you can see that we, over the long term, are still beating the S&P 500. So that's fantastic. Loving that on a long-term basis as well. You can see that they were gaining on us in 23 and 24. And I think the main reason for that is everybody remember the Mag 7. The Mag 7 really drove a lot of the S&P growth during that period of time. So a well-diversified portfolio is not going to perform as well as a 7-stock portfolio when those 7 stocks are driving the entire market. So, so anyway, at the end of the day, we are now pulling away again from the S&P 500. So that's good to see also. Even though this is not the target I shoot for, as you know, is an 8% return per year. We'll talk about that here in a few minutes. All right. So before I get into the portfolio, I wanted to share with you my investing philosophy, the portfolio philosophy. I think maybe there's some new folks here. I haven't talked about this in probably a long time, like a year and a half. So I thought it might be worthwhile to kind of remind everybody that's been around for a while and maybe introduce, for those who haven't, what the portfolio philosophy is for this Wealth Circuit investing portfolio. First of all, we want solid business fundamentals. And we start by looking at their financial management. And I look at their earnings per share. These are just like the major things. And then if I see something that I am curious about, I will dig further. But these are kind of the high level metrics that I look at. Look at earnings per share. I look at sales trends. I look at return on invested capital. I don't look at return on equity. You can also look at return on capital employed. That's the sister of this, but I look at return on invested capital. Operating margin trends, are they improving their margins over time? And the interest coverage ratio, what kind of interest are they paying per dollar of net income? Okay, so financial management is like number one. Number two is capital allocation. And capital allocation, for those of you who are going, what in the world, capital allocation? Well, so let's say that they get to the end of the year and the company makes a lot of money. The question is, what do they do with that? How do they allocate the funds, the capital that they just made that year to grow the business in the future? So they can, they can pay down debt, they can buy back shares, they can pay dividends, they can, invest in, new factories, and, they can just do a lot of things with that capital. So I want to understand how well they do in allocating capital. First of all, I look at their free cash flow. Are they generating free cash flow? Is it growing? The second thing is I look at the payout ratio. Payout ratio is what percentage of their net or earnings per share are they paying out in dividends. Then I look at their shares outstanding trend. Are they staying the same? Are they going down? Are they issuing more shares? I like to see where they're at on there. I like to look at their mergers and acquisitions. as well as their net debt to total capital. So those are the things I look at there. So if you think about it, this financial management, this is really the income statement and balance sheet, and capital allocation deals more with the statement of cash flows. So what are they doing with the cash that they have? And then the third thing I look at is the strategy of the company. Does that strategy leverage the company's competitive advantage? And so then you have to kind of go, what is the company's competitive advantage? It's really the thing that's going to it's a thing they can do that very well that nobody else can do as well as them. That's their competitive advantage. Does the strategy of the company enhance or leverage that competitive advantage? And then fourthly, I look at, do they have a proven management team? I've been bitten on by management teams in the past, and even this year. I mean, it's really hard to tell if they're going to make good decisions or not. So, but we do our best. We look at past decisions. That's really about all we can do. Sometimes they're new management team, so it's really just hard to understand how that management team is going to perform. But here's the deal. Here's why I like that. Because I'm out in my beehives. I'm out, with chickens. I'm out bush hogging the pastures. I'm out, cutting the grass, doing, bottling honey, doing whatever, right? And what I need a proven management team that's going to be managing the investment that I've made in that business. I don't want to be sitting around wondering whether they're going to make good decisions or not. I want to know that they're going to make good decisions. So I look for there being a proven management team. So those are kind of the business fundamental piece of this. And then when I go to, this will be fun. So strap your helmets on here. The thesis for total return. So back up. I look for business fundamentals, financial management, capital allocation, strategy, proven management team. But then I also need to understand, where is the thesis that is going to drive share price or total return. And total return is a mixture of capital appreciation as well as dividends. So I need to understand in my own mind, I can love the company, I can love the management team, I can love the financials, but where am I going to get a return? What about this investment drives additional return? So this is what I look for. I look for income. So this is actually the easiest one, right? I'm a dividend growth investor. So I look for, what kind of income are they going to provide me? Is it going to be, 1% yield? And this is the dividend yield, right? It's the dividends per share. So, versus the share price. So I'm looking for, what kind of yield am I getting? Is that yield 5%? Is that yield 4%, 3%, 2%? So that's going to be, and again, if it's got strong financials, good management team, I can pretty much count that those dividends are going to be there. And I also want them to be growing, right? So I look for that as part of the thesis, not the whole thesis, but it is a factor. It is a part of the thesis. And I want to talk about why I like that. It's more strategic than it is about just getting dividends. So the second piece is business growth. I'm looking for dividends that are growing, and they're growing in comparison to the payout ratio. And let me give you an example of that. I think an example is much easier to talk about, because I bought some shares in a company this week. I added a stock to the portfolio for the first time in a few months. So it was kind of fun to kind of get into a new position. I got rid of Wisconsin Electric, WEC Energy, and I added, for those of you who are in the Discord, if you're not in the Discord, there's a link in the notes to this. It's free to join. Jump in there. I usually will say, what I'm doing. I don't necessarily always say why, but at least I say what I'm doing. And sometimes I get the responses from people like, oh, but anyway, it's fun. So business growth, I look for dividend growth when compared to the payout ratio trend. Here we go. You ready? This is Intuit. I bought Intuit. I got into it with Intuit this week. And if you can see this, look at these dividends, man. These dividends are going crazy. And some people will just look at this and they'll say, oh, I got to get in on that. That's a lot of good dividend growth. But I will tell you, if you stop here, you could be hurting yourself over time. Now, you look at the last 5 years, 14.4% dividend growth. Latest was 15.4%. So they have been growing the dividend a lot. But what's the other thing we need to understand? It is how much our earnings growing, because we want the earnings to be growing at least as fast as the dividend is growing. So let's take a look at this. The earnings payout ratio for Intuit is actually on the decline. So it is growing its dividend like crazy, but its earnings are growing even faster. So that the percentage of earnings that are being paid out in dividends is actually declining. So you will hear YouTube people, I've heard it myself many times, you will hear people say, and I want to warn you that when you hear this, always kind of listen with what they call a grain of salt, right? That means that this person probably does not understand the financials of a business. But a lot of people will say, oh, look at this, it's 20% earnings payout ratio. I don't want anything below 60%. This company has a lot of room to grow the dividend. That is the wrong way to look at this. We want that that earnings payout ratio to remain low, because we want them to take some of that cash and reinvest it in the business. The higher the earnings payout ratio, the more of their earnings they're paying back to us. The more the earnings they're paying back to us, the less they have to invest in the future. So we don't want them to grow this earnings payout ratio. We want the earnings to grow as the dividends grow, so that this earnings payout ratio, remains relatively flat, or in this case, as Intuit goes down. So here, let me give you another chart just to make it a little see how the earnings are growing for Intuit. So the dividends are growing and the earnings are growing a little bit faster, so that this earnings payout ratio is flat. We don't want them paying all of this out in dividends just to grow our dividends. That means they're giving away the company. That means they're paying us back part of what the company needs to grow. We don't want that. We want them growing earnings to pay for the dividend increases. So here's the point. The point is, let the business grow the dividend. You want the dividend to grow, but you want the earnings to grow commensurate with those dividends, so that the earnings payout ratio remains flat. We don't want to eat this. We want that to be what the company uses to grow in the future. All right, so that's the business growth piece. And then the last piece I look at is valuation, intrinsic value less the current share price. Let me kind of give you an idea of why. Well, before I do that, I forgot I had this other chart on here. In my portfolio, I split. There's typically a primary thesis for each stock. So a stock might have some dividend growth, but it might have some a real low valuation, right? It might be trading at something very low compared to its intrinsic value. So if that's the case, it's really more of a value stock. Or if it's growing its dividend like crazy, then it might be a growth company. And if it's, what's the other one? Income. If it's paying a high yield, might be an income play, right? But we want there to be a little bit in every category. We don't want a dividend yield trap, which is where you're getting a high dividend yield, but you're giving it up in share price, right? So because that's not a good investment. We're looking at total return is what we're looking for. And how you fit into that really depends on what your goals are, where you are in your investing cycle. I'm retired, but I still kind of run my portfolio as if I'm not. So yeah, go figure that. So anyway, valuation. Here's a good chart that kind of explains this. Valuation, if you look at this blue line, this is all just illustrative, right? This is not a real company at all. But let's pretend that this blue line in year one is the intrinsic value of a company. And let's say it's a beautiful company that grows consistently every year in value. And so the intrinsic value is going to roll just steady eddy and a upward trend throughout, the 7-year period. This green line is indicative of where the stock price could be, because the stock price could be trading higher than its intrinsic value, lower than its intrinsic value. And so you want to look at whether you consider it to be overvalued, meaning that the stock price is much higher than it's really worth, or that it's undervalued, where the stock price is much lower than you believe it's really worth. So if I think about the three pieces that I'm looking for income, which is dividends. I'm looking for growth, which I look at dividend growth as a proxy for where the board believes the company is going to go from a growth perspective. And then thirdly, I look for whether the company is undervalued. I take those, I marry them together, and I come up with what I believe the company is gonna be worth. So I thought we would take a few minutes and go through the portfolio. You guys okay with that? Maybe I should stop for a minute. You can see what I'm doing here. I'm just gonna go with what I own. And we'll go through that in just a second. So let me come back here, see what you guys are talking about here. Yeah, got my hat in Jackson Hole. Jerome, yeah, he was there. He probably saw that carving I did. Kevin was here. He probably saw that. He's wondering, who is this Kevin guy? But got to take a swig of my half and half iced tea. Let's see. Start looking at ACN. I'll put that on the list as well. We'll take a look at that. ACN. John J. Speaking of yield trap, thoughts on JEPQ or even JEPI, as it also has exhibited both high yield and high growth. Can you take a look? Sure. I'll take a look. Those, I'll take a look at those. All right. And Rust has a quick question. Do I still own T Rowe? I do, actually. It is my lowest, the lowest percentage of my portfolio, though. It is the very lowest investment that I have. But I do have it, and it has a purpose for me, and that purpose is income. So I split out what income I think I need versus where I want to do growth and value. So because I'm a nerd, that's just the way I roll, So let me put this back up on the screen. So you can see here, I will sort this as a percentage of the portfolio. This is my spreadsheet, by the way, that I created. And it is really, I'm really beginning to enjoy this. I've got everything I need at my fingertips. There's ways that I want to make it more efficient, but I really am enjoying the spreadsheet. Okay, so 32.6% of the portfolio is in the S&P 500. I do that because there's, a third of the portfolio that I don't think I'll ever need, to be honest. So for as a legacy for my kids or whoever is going to take over this when I'm gone. I don't want to let the foot off the gas, right? So I have about a third of the portfolio in the S&P 500, but the other 2/3 I invest personally. So I own 6.5% of the portfolio is Microsoft, and let's do this. I think you guys will enjoy this part too. This column here called capital or cap apper is the capital appreciation that I've seen on these shares that I still own. The greens are good, the reds are bad, but we'll hit them all. Microsoft, 6.5% of the portfolio. It is up 55% in the portfolio. This is not year to date. This is, since I started investing in them. Alphabet, Google is 6.1% of the portfolio. It's up almost 30%. And I just started investing in that not long ago, maybe a year or so. Amphenol, I started in January investing in Amphenol. Amphenol is now up about 64%. It's been one of my better picks ever. Even better, I think, than Parker Hannifin was. Now, here's another good one. And remember, these are all just the capital appreciation pieces. Does not include dividends. So dividends is going to be in addition to this. I have a spreadsheet that tracks total return, but that's not the sheet that I'm in right now. So you get to see the capital appreciation. Hess Midstream, I'm at 30% on it, but it pays about, I guess my yield on cost is probably somewhere around 9%, but the current yield is somewhere around 7%. So every year I'm getting 7% in dividends, but it's also grown by 30% over the time period that I've had it in. Let's say I've owned it for maybe 3 years, just for round math. So that'd be on average 10% capital growth plus 7% yield. That's 17% per year. I'm okay with that. That's a good investment for me, and it's pretty consistent. The next one is I've taken a bath on, but it's come back a lot here in the last couple of weeks. It's a United Health Group. I think I'm going to hold it long term, but I do not think the struggle is over yet. I think there's still some investigations going on. I even have considered, maybe I get you guys' thoughts on this. I've considered balancing between United Health Group and Elevance Health. Elevance, you can see down here. Make sure you can see that. Elevance is 1.9% of the portfolio. United Health Group is 3.6%. I've considered unloading some of the United Health Group and balancing it more with Elevance, because Elevance doesn't have the investigation overhang like United Health does. So what do you guys think about that? Does that sound reasonable, rational? Should I continue to hold UNH as it is, or should I try to balance those out a little bit? They're both in the same sector, so that's why I'm asking. Next is Carlyle. Carlyle is a brand new company for me. It is 3.5% of the portfolio, and it is up almost 15%. So I think I've been in it maybe a month or two, something like that. So that's pretty good. Now Parker Hannifin, it just it's like the Energizer Bunny. It just does not stop. I've considered trimming that a little bit, getting it down to about 2.5%, but it just keeps growing. So I'm leaving it. I think that they've got a great management team, good strategy. Their financials are good. I think I'm just going to leave it. Atmos Energy is 3% of the portfolio, 66% return. And it's not return, but capital gains. SOX, which is a ETF for the semiconductor segment, 42% gain on it. It's 2.9% of the portfolio. RTX Corporation, which I wish I had bought much more of when I did, but it kind of got away from me, right? Where's it at? RTX is 2.8% of the portfolio. It is up 84%. U.S. Bancorp, man, we had a good day Friday from U.S. Bancorp. It is now up 36%. So let me just take a pause here for a second. Anything in this range here, I consider this to be normal weight. These are kind of underweight. This is, I'm sorry, there's more. These are overweight positions. So, I've got a whole bunch of normal weight positions, and one of these days I want to get these others up, but it is what it is. I just thought I'd share that. Next is Hershey. It is one that I have a negative capital appreciation on. If you add dividends in, I'm actually positive, I think. Maybe let's look real quick. The Hershey Company. It's not under H, it's under T. I don't know why. Yeah, so I'm up $937 on Hershey. Let me pull it up a little bit. So you can see Hershey here. They've got $1,600 worth of dividends, so I'm up $937. But capital gains, I'm under by $740. So that's the Hershey Company. The next is Johnson & Johnson. It's been my steady Eddie. I mean, they've really struggled here, the last couple of years. But, it's up 23%. Visa is 2.5% of the portfolio. It's at 31%. Verizon, I have from an income perspective, but it is currently up 13%. General Dynamics is up 62%. Now, Intuit is the one that I just bought this week. I went in at a strong 1.9% of the portfolio. And if it drops from here, I will add more. And it could be one, if it continues to drop, it could be one that I go ahead and go overweight on up to 5%. But right now, I'm comfortable with 2.5%, 3%. So I'm in at like a 1.9%. So it's actually up by 0.5% from where I bought it. Lockheed Martin, about 1.9%. It is up 27%. It's had a rough year, though. And Elevance Health, we talked about that, is down 20%, 1.9% of the portfolio. Northrop Grumman is one that I added this year. It is 1.7% of the portfolio. It is up 20%. EOG Resources I've had for quite a while. It's up 35.7%. Has done relatively nothing over the last year or so. But I just can't bring myself to get rid of it. And then for Rust Moments, Rust, 1.3%. I think his name's really Nathan, but 1.3% of the portfolio is in T. Rowe Price. It is up 23.8%. It's also got a dividend yield. Let's find that. Dividend yield of 4.7%. So I think I just bought that this year. I had it before and got rid of all of it, and then now I've just started buying it again. So, I'll take that. That's a pretty good return for, let's say it's been the last 12 months. That's a pretty good return. So I thought I would go through that, share that info with you guys. And I haven't gone through in detail my portfolio in quite a while. If you missed any of that, you're certainly welcome to, stop the video and go back, or just watch it again sometime. It's free entertainment, man. That's why we're here. All right. So now what do we want to talk about? Let me kind of catch up with you guys here. We got Hassan. Good to see you, my friend. Good to see you again. Got tied up in one of these Justice YouTube videos. Sorry, I missed the open. Hey, no worries, man. It's always good to go back and catch up. You know what I'm saying? Then, so Billy's got some advice for me here, and Billy's somebody I respect a lot. He and I are in very similar situations. He says, don't sell UNH, just add to ELV. That's what I'm doing, but I have full positions. I keep on adding, though. Okay. That's not a bad thought. But I'm going to have to sell something because I only have, let me take a look. What do I have? I've got 1.3% of the portfolio for cash, and that's about 22,000. So I could add something, but I'm going to have to get rid of something. That's why I had to sell WEC to add into it. It's because I needed to get rid of something to add what I believe is going to be a real winner. So, but no, that's a good thought. So I'll just hold on to it for a while. We'll see what happens. So Hassan, yes, I did. I got to spend a little time with TPL. So we'll go over that if you want as well. Okay. And Michael also is long actually in TPL, so that's good stuff. Okay, so let's just do that. I know I've got some things here on the list. So we've got TPL, we got CTO, we got BUI, we got ACN, and we got JEPQ. So let's take TPL first because that really is left over from last week. If you guys want to, we will go there. So yeah, I did get to spend a little time with that. There we go. I just got a text message. Let me see what it says. Oh, that's great. It's good to know. It's my bank telling me my checks are on the way. That's good. Okay, so TPL. So first of all, Morningstar. This is Morningstar here. They do not cover it. They have what's called a quant valuation, and that valuation here is fair value of $760. They're saying it is 18% premium. They're saying it's overvalued, but I don't really trust this because it's just based on quants. It's not based on like a human looking at it and saying, hey, it is really worth this based on these things. It's just looking at some numbers. So I don't necessarily trust that valuation. So let's take a look then at some other things. And where do we want to start? Let's say, let's look at the year-to-date performance, down 18%. 1 year is up 4%. 3 year is up 47%. 5 year is up 403%. Let's look at some of the financials. TPL. Remember, financials is a big thing for me. Texas Pacific Land. It's got a 60 dividend safety rating, but let's take a look at this dividend is growing nicely. Let's take a look. Remember at our earnings payout ratio. It's actually growing as well, but it's pretty low. So I'm okay with that. The question that I had, I think last week is, let me make this a little bigger so you guys can see it. Is that better? Their free cash flow payout ratio, I need to make this a little bit smaller. Free cash flow payout ratio is 180% in 2024. So my question was, what in the world are they doing, right? So what I found out is that their free cash flow was impacted by them buying some additional, what do you call that when you have rights, mineral rights to, so they paid a lot of money for some mineral rights. It really is a long-term investment. It's a capital investment. That's why it shows up in free cash flow. Different than if they're buying a company or buying back shares. Those types of investments don't get counted as part of free cash flow, but the capital expenditures do, and that's where these mineral rights have fallen. Because they don't own the land, they only own the rights, and so therefore they are accounted for as capital. So the operating cash flow minus capital expenditures is the free cash flow. When they spent all that money in that one quarter to buy those rights for the future, it popped there in 2024. I'm not concerned about that. I think that was a good investment. So I'm not worried about that 180%. So hopefully that makes sense. And What else can we look at before I give my thoughts on it? Let's see if I didn't even look at this for TPL. Let's see. This is fast graphs. And we can see that I like to do, well, it's only a 6-year time frame, so they haven't been around long. So, they're trading a little bit above where they have historically, from a PE perspective, traded. Let me get rid of this. There. So this blue line is their typical PE ratio. So, is it a great time to buy? Probably not. But is it a bad thing to own? I would say probably not either. I think it's worthwhile to own. It's let me give you some thoughts on it. So they own a lot of rights. They also own some water, if my memory's right, some things to do with water. So but these rights are around the like energy, around gas and oil. That's why they're in the oil and gas production. They don't produce any oil and gas. They are only like they take a piece of every gallon or barrel or whatever that is extracted from the ground, but they don't actually do the extracting. They own the rights to those minerals. So, but they also are at risk, even though they're not directly impacted by the price of oil and gas. They are indirectly impacted because it could reduce the amount that they would get for every barrel that comes through. So I think that's important to keep in mind. Secondly, so I'm looking at the downsides now, right? So the downsides are they're at risk because drill, baby, drill. If the price of oil goes way down, this could impact them. It's not going to like kill them, but it would impact their margins moving forward for a while. The second thing is that they only have a 0.71% dividend yield. The rest of the value, from my perspective, is growth. So it is a growth play. So if you're looking to get income, it's not the play for you. It's only 0.71%. But if you're, and it's from a valuation perspective, it's not giving you any value there either. It's definitely growth oriented. They have grown their dividend by 36.8% in this last time, and they have on average grown by about 24%. So let's plug this into the model and see what happens. I'm going to undo this. I've actually plugged it in already. I just have to find it. So TPL, Texas Pacific. Here, let's do this. Texas Pacific. All right, here we go. Start over here at the beginning. I'm showing an annual return potential of 18%. Analysts are at 27%. That's not a bad return. Again, it is growth oriented. So if you're comfortable with growth being the predominant driver of value with the stock, then I don't think it's a bad investment at all. So analysts are saying 27%. I'm saying 18%. It's got a wide moat, according to Morningstar. It is, again, above their fair value, but I'm not sure I really trust that a lot. They have a 38% return on invested capital. That's fantastic. Dividend safety is only 60. I'm not sure why, because it's such a low yield. I'm not sure why it's coded that way. But again, it is definitely growth oriented. So I think it's worthwhile. It's very. I think you got a lot of potential there for growth. So I would say, rock on, man. Yeah, and that's right, Michael. It's got zero debt. So I would say rock on with it. If you own it already, I would hold on to it. I don't know. Again, I would have to sell something to buy it. But if I had the cash, I might actually consider it. So I've added it to the sheet, and as you can tell, it is number 5 on the list here in terms of the way my spreadsheet calculates potential. Oh, I'm sorry. No, I just lied. I lied to you guys. Here, let's do that. It's number 5. So regardless of how I sorted the list, it's number 5 on the list. So that's good. So yeah, it's definitely worthwhile. I like the stock. I like what they're doing. Seems like the management team's making great decisions. So, I don't think you can go wrong with it. So those are my thoughts. My opinion. Let's see, where did I leave off? Yeah, so Michael here says the mineral rights generally bear none of the expense of exploration. That's right. It's a cost-free asset, but it does, based on what I read, it does get impacted as the commodity price moves around. It does. If it goes down, it does flatten the margins on that asset. But you're right. They don't have a cost to the production piece, but they are at risk for also the volumes that come from that. So just like the driller, if they hit big, it's a payday. If they don't hit big, it's not as much of a payday, right? So they have some volume risk as well as some price risk, but they don't have the risk of actually doing the drilling. So I think that's what Michael's point is here. And they have zero debt. Yeah, so they sometimes pay special dividends, and that makes sense because other companies that are explorers, like let's say EOG, will pay a special dividend when oil prices are really high because they are really making a ton of money. And so that's one way to reward shareholders is to give those special dividends. So that makes a lot of sense, actually. And you are welcome, my friend, anytime. Let's go on to the next one. Let's look at CTO. Find my screens here. I think this is a REIT, if my memory is right. CTO Realty. It's got a 50 borderline safe. It's got a dividend yield of 9%, which is kind of high. So anytime you have a high dividend like this, high dividend yield, I want to ask the question, why are investors allowing that yield to be so high? That means that they're not wanting to invest in the company enough to drive that yield down to a normal level. So let's look at their dividend growth. It's been flat since 2021, been pretty flat. Although it says 28% over the last 5 years, but it's really from 20 to 21, it went significantly higher. So you can see that big move there. If it was just over the last 4 years, it'd be much lower than that. What else can we look at? You can see that it's just flat in the dividend growth. The adjusted FFO, since it's a REIT, that's the most appropriate thing to use. 77%, it's not bad. That means any growth that it is seeing, it's covering, right, in the business. See what, so they are issuing shares, which is not unusual for a REIT because they're typically paying out 90% or so of their earnings. And so if they do that, they've got to issue shares to invest in more stuff. Sales are going up. Return on invested capital does not look that impressive. A 1%. So since 2017, it's been 1% or 2% every year. That's pretty low, even for a REIT. I mean, I would want to see probably around 4% from a REIT, to be honest. So net debt to capital is not too bad, about half. Interest coverage ratio, not good, my friend. It is below 2. That means that they aren't making really a lot of income. They're only making 60 cents of income for every dollar in interest that they're paying, or something like that. So it's that's not good. I think I would, if it were me, I would move on. I think there's other things that that we can invest in that would give us more. All right, so so that's CTO and TPL. Now let's look at BUI. BUI, BlackRock Utilities, Infrastructure, and Power Opportunities Trust. Now that is a mouthful. So it's a trust. So that's interesting. So I'm trying to think. Oh, it's a closed-end fund, so that kind of makes sense. And invests in utilities. It's got a dividend yield of 6%. Dividend growth is pretty high, though. Last 5 years is only 0.2%. Wonder what happened that gives them the ability to do 12.4% in 1 year. So when I look at things like this, I don't count this as real. I would count the 0.2% as real. It went from 12 to 13.6. Valuation. Let's see, what else do we have to look at here? It's a closed-end fund, so we're not going to get as much stuff. Total return. I mean, it looks pretty decent in terms of total return. Yeah, it doesn't look bad at all. I don't know why all of a sudden they could bump the dividend by 12%, though. I would want to look at that. And they don't say in the write-up here. That'd be a question I would have. The trust seeks to achieve its investment objective by investing under normal market conditions at least 80% of the total assets in equity securities issued by companies that are engaged in the utilities, infrastructure, and power opportunities business segments anywhere in the world, and by employing a strategy of writing, selling, call, and put options. That would make me a little bit nervous, and I don't know if we have enough time for me to go into that. And I'll tell you what, I'll combine that with the discussion on JEPI and JEPQ. I think it's fine to have, a strategy of trading puts and calls. I've done that myself in the past, and but I will say this. Anytime you sell a put and get money for it, or sell a call and get money for it, you are basically taking on the risk that the stock price is going to move higher, right? So if you sell a put, that means that, well, I don't want to go into all of that at this point, but just know that you have downside risk in selling puts and in selling calls. You don't have upside protection. So if the stock price goes down, you lose. If the stock price goes up, you lose. So it's you gotta, for options to make sense, you want it to trade within a range, and that range is going to be where that sweet spot, and that way you get to hold the equity, and you don't get pounded when the stock goes down. You don't lose your stock when you sell a call option when the stock price goes up, and you get to keep the option premium. So I would struggle with this, especially with the checkered past that it has. Those are my issues also with JEPI and JEPQ. They trade a lot of options, and I think there's just a lot of downside risk there that it's not symmetric risk. I like to get asymmetric risk, where you have more opportunity than you have risk of downside. And that's not the case in these covered call strategies or covered cash secured put strategies. So that's kind of where my head's at on that. just so we're all clear. All right, so last but not least is ACN. Let's take a look at ACN. Oh, Accenture. Yeah, that's in my spreadsheet. I like Accenture a lot. So where does it fall? Here it is. It's on line 12, but the header line is line 1. So it is actually the number 11 item in my list. I have almost bought it several times, but I just never felt like I could pull the trigger on it. My spreadsheet says it's going to be about a 16% return over the next year. Analysts are saying 31%. It is a wide moat. It's roughly at fair value. Return on invested capital, 22%. Fantastic. 92 dividend safety rating, 2%, 2.3% yield. They also have a buyback yield about the same, so about a 4.5 total shareholder yield. But here's the cool thing about Accenture. They are a consulting firm. I'm trying to remember who they split off from. I think it was Arthur Young back many, many years ago. But Accenture is a consulting firm. They have expertise in AI. So from a consulting perspective, Accenture is a good play for some AI exposure. So, is it a worthwhile investment? Yeah, I think it is. I think they're a fine investment. I don't own them at this point, but it's not because I haven't thought about owning them. It's just that I've bought other things. So Intuit, for instance, is number 8 on my list as opposed to Accenture, which is number 11. So, it just keeps getting edged out by other things. And so I'm now a proud shareholder of Intuit, but I do not own Accenture, but it is a stock that I do like, and it is one that I have followed over time. So hopefully that helps. And we have gone way over. It's an hour and 7 minutes. I appreciate you guys joining tonight. We had a lot of fun. There was a lot of stuff here to chat about, and so I appreciate you sticking with me through this. But I think it's important to understand, at least for you guys to understand what my philosophy is, what my theory of making investments is. And, it like I say, if you like it, you can steal it. If you don't like it, what did it cost you, right? It didn't cost you anything. So I just want to share it, be as transparent as I can, show you the performance of the portfolio. If that makes any if that helps you at all, then that's great. If not, just leave it alone. It's not going to bite. So anyway, guys, I'm going to get off of here. I'm going to go finish drinking my tea so that I can get up in the middle of the night to go to the bathroom. So I'll just catch you on the next one. We'll see you guys.